take a look at how Indian markets are performing at the moment. Obviously, a very positive IPO there for ICICI Prudential. And the mood overall, one of optimism today. We've got the Sensex pushing higher now by about 0.2%. All of the major indexes in India higher, although we're seeing some risk-on sentiment, modestly so, across the entire region today. Take a look at the Rupee, though. It's back below 90. Oh, there it is, back above 90. But it has strengthened after the intervention that we've seen from the RBI this week. So it appears to have worked in the short term at least. However, risks do remain to the currency, but the IPO right now, the Indian Rupee right now, just parked above 90 there. So let's talk a little bit more about that stage back, that comeback. It has come after weeks of softness over the last few sessions. The currency has gained about 1% against the dollar, reversing away from that record low of 91 that we saw earlier this week. Now, the RBI is believed to have stepped in pretty aggressively, selling dollars and buying bonds worth 500 billion rupees to calm the markets. And that intervention sends a clear signal to speculators betting on further weakness. Still, analysts warn the pressure is not over. Foreign outflows and trade uncertainty keep the currency vulnerable. For more on the rupee's moves, let's get to Mumbai and Bloomberg News senior editor Menaka Doshi. So, Menaka, tell us, on the wake of that intervention we saw from the RBI, can we say that this battle is won yet, or is there potentially some further rupee weakness in store?
Well, far from one, Paul. As you pointed out, that intervention earlier this week has helped, sort of the rupee recover from 91 levels, which was a fresh record low, to, as you just pointed out, 90 levels. But most economists and currency experts I speak to say that that relief is going to be short-lived. Now, the fundamental problem or the reason for the rupee's weakness is capital outflows from the country. And then, of course, the absence of an India-US trade deal has added further pressure, even if you call it sentimental pressure. Now calls for further weakening in the rupee range from between 93 to 95 levels for the first part of 2026. And the key question, Paul, is what impact will this have on the country's growth and its economy? Now, to answer that, I'm joined this morning by Somnath Mukherjee, CIO and Senior Managing Partner at ASK Private Wealth. And also joining us is Anubhuti Sahay. She's Head of India Economic Research at Standard Chartered Bank. So Anubhuti, Somnath, thanks very much for being on Bloomberg. Anubhuti, let's start with you. What do you make of the rupee's underperformance this year, Asia's worst performing currency, despite the relief we've seen this week?
I think what you highlighted at the beginning is, lays out what drives the rupee weakness very nicely. At the core of the problem, I would break it down in terms of three factors, which is driving rupee weakness, and probably these three factors will remain rupee weakness or will keep rupee under pressure going into 2026. Our forecast is at 93 by end of December 26. And as I mentioned, there are three factors for it. One, weakness in capital flows. If you look at last year, India's capital inflows or net capital inflows were the weakest since global financial crisis. It improved a little bit in this financial year, but again, it's one of the weakest in 1.5 decades. And next year, again, we don't think it will improve to what we saw a decade back also. And that is primarily led by very, very soft FDI inflows. Until the time we really get a visibility of FDI inflows turning around in a significant manner and in a sustainable way, I think this weakness in rupee will reflect or will try to reflect the weaker external inflows. And that theme would remain very much dominant. Second, increased tolerance at the RBI level for a weaker rupee, because they are trying to realign rupee levels with a weaker capital inflow story. They still have very healthy reserve cover or import cover, close to 10 months, even if you adjust it for forwards book. But as visibility on collecting back lost reserves or building FX reserves higher is very low, it is important that rupee is allowed to be a shock absorber while ensuring that external sector remains resilient on a medium-term basis. Third, I think even if you get some inflows next year, a pullback looks very unlikely because RBI will use every single opportunity to rebuild FX reserves, especially as the global environment remains highly uncertain. So I think what we have seen over the last 1.5 months would remain dominant going into 2026 too.
A quick follow-up, Anubhuti. What level do you expect the RBI's intervention to be the most at? You're saying 93. Are you expecting the rupee to achieve that in the first 3, 4, 5, 6 months of the year?
93 is for December 2026, Menaka. In the first quarter, that is in March quarter, we are expecting a little bit of a balance of payment surplus. Current account has a seasonality, and that possibly it will turn into in the positive terrain. Capital inflows might also see some respite, and that should support rupee. And probably RBI's intervention might not be needed as strongly. But going forward, our view is that RBI's FX intervention strategy will remain more towards smoothening the move in rupee rather than defending a particular level. It's very difficult to say at what level they will come very aggressively, but I think the broader message which we got even from RBI governor's interview that 3 to 3.5% appreciation on an annual basis is trend in rupee. I think we'll need to take that as the broader guiding light going into 2026.
All right, the key question is capital flows, Somnath. Not just FDIs, Anubhuti pointed out, but FPI, over $18 billion leaving the country this year. What's going to change that next year? What's your outlook?
Yeah, so a couple of things on that. I think between FPI and FDI, and some of it is sort of fungible. The bigger reason why we've seen weaker flows this year or net outflows this year has been that the buoyant and very deep Indian capital markets, and we just saw a very large listing just before this program started, has meant that it has given the opportunity to a whole range of larger strategic investors, including the largest of them being global private equity, take money off the table and return money to their LPs. And that's been an overriding theme with especially private equity globally. The LPs have been demanding DPIs or distributions rather than merely paper IRRs. Sure. Outside of the US, India is one of the very few markets that offers the depth and liquidity that allows large-scale exits for investors. And that's something that's been taken very aggressively over the last 2-3 years by several types of strategic investors. So that's been the big reason. Will that reverse next year? I think to a certain extent what will reverse is that the gross inflows are likely to be higher, driven by a couple of things. One, valuations are somewhat better than what they were 12 months ago. Second, like all cycles, we went through a bit of a down cycle into 2025. We are looking like, given all the high frequency indicators, towards a reversal of that cycle. So there is likely to be earnings upgrades going on from the next quarter all the way. And that's going to attract more money. And last but not the least is a global coordinated easing of sorts of central banks, which should take yields down from the levels we have seen this year.
It seems to be coming to an end now, isn't it?
It's all data dependent, but from all indicators, there is very little to show that there is merit in keeping rates high. Look at India. Our real interest rates are amongst the highest in the world. Our nominal GDP growth today, the spread between nominal growth and 10-year GSEC is one of the lowest we have seen in history. Actually, that effectively means that it is less attractive for a strategic investor to invest the money into productive assets simply because the spreads are not there. So there is actually not a massive amount of incentive for producers or for manufacturers to set up new capacity. And that's going to drive policy making this year. And that's where the rupee weakening actually is a good outcome today, because it acts as a shock absorber. It leaves monetary and fiscal policy alone to focus on what is truly important, which is growth in jobs, which is what we expect the central bank to do for 2026. Focus on reviving growth. And by reviving growth, I mean nominal growth. Right now, we have a really healthy real growth on the macro side, but reviving growth across the board. And that should bring back the headline gross inflows from foreigners as well.
All right, so you're talking about the advantages of a weakening rupee. Anubhuti, what do you see as the overall macroeconomic impact of a weakening currency, both from the import side of point of view, though we've been lucky that crude has been manageable, but also from an export competitiveness point of view?
So I'll answer your second question first. From export competitiveness perspective, rupee weakness would help, no doubt about it. But I think we also have to remain cognizant of the fact that Indian exports or exporters are price takers rather than price makers. Plus, we also have this whole uncertainty around US-India trade deal. So it helps, but I would say it's an incremental support for exporters rather than a massive support. Second part, how does it impact import? As you very rightly said, I think it is definitely not a positive from import perspective. But at the same time, given that commodity prices across the world remains extremely low, our sense is that the impact is likely to be limited. You spoke about crude oil prices, and it's very interesting to see that even though crude oil prices have corrected by $10 to $12, if we compare it to the start of the financial year, our oil deficit has remained pretty strong. I mean, deficit is actually marginally higher than what we saw last year at the same time. And that's because we are importing a lot more. So I think there are a lot of factors which are at play. One, that we are growing at a faster pace than rest of the world. Second, that select commodities like gold are going through very, very high prices. So, barring gold, I think for rest of the commodity space, low prices should help to counter off any large impact from a weaker rupee.
All right, so how does this set us up, let's say, for the government's key agenda points in, 2026 or FY27, combining both years? So Somnath, assuming no deal is signed, because we've been hoping for this to happen over the last several weeks, it hasn't. Assuming no deal is signed, what will be the key priorities next year? We're just a month away from the union budget.
Right. No, actually, it seems that the ceteris paribus condition, to use that expression used by economists too often, it doesn't look like either government is in a hurry to do a deal, whether it's the US or India. We've seen very bullish statements, but none of those look like that either side is bending over backwards to get a deal done. I think we should take it as a positive news when it comes, rather than trying to price in the fact that it will come in a short period of time, which is where the depreciation of the rupee is actually a good portend, because albeit imperfect, it's still a defense against losing competitiveness in the export market. Our trade-weighted tariff today is 2x that of any other relevant peer country on the export side that we have. And hence, the government can therefore focus very sharply on ensuring that domestic levers of growth, which would primarily be the engines of growth because exports are tough, do come into play, and they focus on that.
Quickly, when you say domestic levers of growth, what does that mean?
It has to be consumption. So consumption is 60-65%.
We've already done the tax cuts this year.
We've done the tax cuts. More needs to be done. Whether it is in terms of...
We're a country consolidating its fisc. We've done the tax cuts. We have limited spending power. What can they do?
First of all, I think while we have done a great job in terms of consolidating the fisc, ideally it will be great if the government let it loose a little bit in 2026, because we've seen the impact of a tightening fisc for a good 3-4 years, since the COVID peak. And it's, at this current moment, doesn't seem to be the most obvious policy choice to boost growth. Let the currency weaken, let that be the shock absorber while inflation is still low, let the fisc loosen a little bit.
That's the CIO speaking. Let's ask the economist. Anubhuti, what do you make of a potential shift in fiscal consolidation, though the government has offered no evidence of that so far? And then quickly, your key things to watch for in 2026.
Sure. So I think I have a disagreement here with Somnath when it comes to loosening the fiscal policy. I completely agree that policy has been fiscal policy has been consolidating since COVID years. But COVID was a crisis period, and we really cannot, as a country, run a double-digit fiscal deficit on a year-on-year basis, or at 7%. Even today, we are running a fiscal deficit of 7% of GDP, combined, central and state put together. And that's high by any standards. And the second point is that the government, as well as the RBI, have pushed a lot of counter-cyclical measures in a very short span of time. I think the time is now to focus more on structural issues if India wants to avoid running in circles again and again. It's important that structural issues, whether it is about ease of doing business, whether it is about tax consistency, those are addressed. Because if you look at the overall growth inflation dynamics, they make India look like in a sweet spot, but have they really resulted in job creation? Right. Have they really resulted in attracting massive amount of FDI inflow? So there is far more structural issue rather than just focusing on counter-cyclical measures. Counter-cyclical measures can complement, right, but cannot be a remedy for what India has been going through over the last couple of years.